This week is a big deal because it's Bank of Canada's rate hike week. Now, rates did go up the widely expected 25 basis points, and now target rates are at 4.5%. But more importantly, we are looking for signs that rate hikes are ending. So in this video, I'll summarize what went on and where things might be headed right after this. This is a heads up that you can get our complete Toronto real estate investing guide for free on our website. You can see things like a breakdown of typical costs, rents, appreciation, sample financials that you can change up to see how it affects your returns, and even try out a quiz to see what might fit you best. I'll put a link to the free guide in the description below. Don't forget to like this video and subscribe to our channel so you don't miss other content like this made just for real estate investors in Toronto. We've been seeing more signs that inflation is coming down. It's more clear in the US with headline CPI falling at the fastest pace since 2020. And even though core CPI is still going up, you can see that the price of core goods is coming down, and the price growth does come from core services, which typically lags, and that's pretty much expected. On the Canadian side, honestly, it's more mixed. Job numbers were a huge shock, coming in way higher than expected. But then CPI came in better than market expectations. And if we compare where the BOC thought we would be at year-end 2022 from their October 2022 monetary policy report predictions, actual numbers actually came in much better too. The BOC expected CPI to be around 7.1% by year-end, but it actually came in at 6.3%. So from the central bank standpoint, inflation improvements are actually coming in better ahead of schedule. In today's announcement, the BOC touches on pretty much the same topics. They talk about how the labor market is still stronger than they want it to be, but higher interest rates should slowly work its way through our systems, and our economy should slow down this year and the next. More importantly, it looks pretty clear now that based on today's information, they do want to monitor how these rate hikes are working, and they do plan on holding rates at these levels for the next while. But the caveat here is that it's not 100%, and they continue to emphasize that they might continue to raise rates in order to take inflation back to 2%. So all of these signs are making it more and more likely that we are at the end of rate hikes, and that's what our big banks are thinking right now. Now, if that's the case, the next big question would now shift to when will rates start to fall? Right now, TD and Scotia predict that it will be as early as Q4 of this year. But we think central banks are going to be a lot more cautious than that to prevent inflation from rebounding much higher. So a safer bet would probably be that rates would start dropping in 2024. By mid-2024, the average view from the banks would be that the rates would come down by around 100 basis points, and then it might come down another 50 basis points by year end. Honestly, the range of guesses for where rates will be by year end of 2024 is pretty big, and that's because 2 years in our very uncertain market is a very long time, and a lot of things can happen between now and then. But one thing that is more obvious is that the general consensus is that interest rates won't be as low compared to what we've been used to for the past 10 years. So instead of seeing neutral rates between 2 to 3%, I think we'll probably edge higher than that, with the midpoint being closer to 3% instead. Having said that, the mentality of what is needed to tame inflation is certainly changing. BMO was probably the most bearish with their outlook, saying that we would need to see a huge spike in unemployment to get inflation down. But now even they are softening their stance and saying that the soft landing that we were hoping for might actually be more possible now. It seems like the central bank does agree here, because they did up their GDP forecast for 2023 ever so slightly. In the end, the biggest factor that will determine where real estate will go will still be highly dependent on interest rates. So if we see a recession come sooner, which will then speed up the rates dropping sooner, then it's probably viewed as more positive in our current real estate market, since it will make things more affordable and cause a pickup in demand. But the more likely case is now currently that rates will hold stable. And if that actually happens, then we will end up seeing more stagnant prices in the real estate market. Right now, prices aren't moving much because buyers can't buy, and that's because there's not a lot of listings because sellers are holding back, hoping for rates to come down sooner and prices to rebound sooner. But once more sellers start to accept that rates aren't going anywhere anytime soon and prices aren't going anywhere anytime soon, that's when we should start to see more listings from those who need to sell come onto the market. The fact that prices aren't going anywhere anytime soon also means that that speculative demand that gained a lot of speed over the pandemic isn't coming back anytime soon. There will still be investors that will buy under these current conditions, but the focus will shift back towards fundamentals, focusing on rental income and cash flows that make sense at these higher interest rates. So what this means is that once more sellers start to sell, markets where prices aren't affordable yet will need to see prices drop more to affordable levels for rental income numbers to work. And once they do, these rent yields, or cap rates we call them, will have to hold still at these levels because we're not expecting rents nor interest rates to move much this year. The good news is that we don't expect the same prolonged slowdown in real estate that we saw in the 90s, and the big difference is immigration. Once our huge Canadian immigration targets actually kick into effect, this increased need for housing will cause rents to come up again. And by that time, we should be closer to cooling interest rates well into 2024, and that's when we might see Toronto real estate price momentum start to come back up. The numbers actually work these days for freeholds with positive cash flows, and so we do believe that we're actually pretty close to the bottom already in the low-rise market in Toronto. At the same time, you might feel that there's no real rush to buy right now, given that conditions aren't expected to change much for the rest of this year. But here's the other thing you need to know. Mortgage stress tests are getting harder, probably by the second half of this year. Basically, you'll end up with the best picks on the market if you have a bigger budget to work with and more to choose from. So it's probably a better idea to take action sooner than later when you can qualify for a bigger mortgage. And if you want to talk strategies for buying Toronto real estate in 2023 and get help with buying the best opportunities in Toronto real estate, let's chat. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto, and here's how it's like to work with us. First, we'll do a discovery call with you so we get to know each other more and help you get your financing ready, and then we'll teach you how to analyze deals. Once you're set, our sales team will work with you to find the best opportunities on the market and eventually help you buy the best one for you. Houses typically need a bit of renovations, and we'll help you with a detailed scope of work and contractor connections. And then once you're ready to rent out the place, we also have leasing and property management services if you need it. So if you want to learn more about any of this, just head over to our website at the link down below. Again, don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. You can also head over here to check out our other videos. Thanks so much for watching, and see you in the next video.